Minutes to the opening of the market, and it looks rather grim. Dow down 140, NASDAQ down well over 100 points. Mike Lee with us. You know, you've got a fairly negative outlook on the market and the economy, interest rate slowdown, et cetera, et cetera. So my question is, are you selling anything?
Yeah, well, look, I think I'm going to lighten up all of my equity exposure in the next coming days. And lighten up my fixed income exposure, given what's going on. And it's, you know, from an investor standpoint, you want to keep politics out of this. But the fact of the matter is, we're looking at a $2.5 trillion deficit this year, which will be the third largest ever, the second largest in a time of expansion. And I think that has a lot to do with what's going on in the long end of the fixed income curve.
So look, okay, if you say you're lightening up on the equity side, stocks. You're lightening up on fixed income, bonds, I take it. So what are you doing? You're going to cash? You're going to treasuries? Is that what you're up to?
Yep. Short term, so taking away from intermediate and long-term fixed income, as well as equities, into short-term treasuries, taking in 5.5%. Because, Stuart, I don't know how accurate a lot of the jobs data and consumption data we're getting, because every single jobs number we got this year on the first announcement was above expectations, only later to be announced below expectation. That's a 12 standard deviation probability, which has so many zeros I can't even count that high. And then in GDP last week, the personal consumption revision was a 9 standard deviation event. Okay, without some sort of chicanery, these numbers are not really explainable. So with tax revenues being down 10% year over year, even though they were expected to be up this year as recent as May, I'm thinking this is getting a little bit uglier, and I think interest rates will come down, but not for the reasons that people want.
So we just put on the screen there the yield on the 6-month Treasury, and it's 5.85%, 5.85 right now. So if I put my money into a short-term Treasury money fund, so to speak, I'm looking at, what, well over 5.5%. I just don't see what's wrong with that.
Yeah, absolutely. And that's, you know, I thought we were going to get a turn on the long end, and I thought we were kind of, you know, just a couple of months ago, we were kind of out of the woods on equities. But what the equity market is priced on right now is a reacceleration of earnings growth into next year. And with all of these headwinds, I just don't see that as a remote possibility. So look, I thought we were going to have a recession earlier this year. I was wrong. Okay, so instead of being, you know, 85, 90% in the markets, we're going to take that down to 75, 80%. So adding a little bit of cash, and then from the fixed income exposure and things further out on the yield curve, we're going to reduce that by 5 or 10%.
The future of the stock market depends almost entirely, not entirely, but largely on the future of profits from American corporations. And you're saying that profits will not be good next year. That's your base case, right?
Yeah, well, right now the market is priced on a reacceleration of earnings growth, and that will be up high single digits next year. If tax revenues are down over 10% and will most likely be down again next year, with interest rates staying higher, I just don't see how it's possible.
Okay. We liked the old days of the Super Bowl, Mike Lee, and we'd like to see him come back, but not for a while, I guess. Mike, thanks for